We're looking at 11,270 on the Nifty and pretty much quiet with a negative bias across the board. Names like Yes Bank, Tata Motors, as well as ICICI Bank and M&M are under pressure. But let's also address news within the mutual fund world. And remember, we did have the AMFI data as well that came out. And we have seen the flows sobering to a certain extent versus the kind of strong flows that we've seen so far. As of now, you also have the liquid fund outflow, which is at nearly 1.4 lakh crores. To talk about this and lots more, we have Dhirendra Kumar now joining in, CEO of Value Research. Thanks for joining in. Dhirendra, to begin with, September equity flows have certainly taken a hit. We've seen the AUMs flat on a month-on-month basis. What do you think explains this?
No, the values were down because AUM is an aggregation of, inflows as well as the outstanding units of mutual funds. If the market value goes down, AUM will come down. But, looking at the flows and what has been a remarkable thing about the equity fund and the retail investors' interest in equity fund, that I think has been compounding. SIP, the design of it is something that once you start, you are there and you continue doing it. One has to see that are SIP stopping? Is the net number of folios on for SIP is it slowing down? Not really. In fact, AMFI data yesterday itself disclosed nearly 2 lakh SIP accounts added during the month, which is quite remarkable. Given that we have seen these big shifts, my sense is that despite the big announcement on corporate reduction in corporate tax coming down, and most mutual funds, the popular funds, the big ones, they actually gained in value. So it is actually reflecting on the fact that mutual fund investors may not be very pleased with the performance. That is a reflection in the AUM, but I don't think the interest in a mutual fund is waning down in any manner.
But Dhirendra, as per our understanding and as per the granular details of the data from AMFI reveals that it's largely liquid funds which have seen the massive redemption come in. What does it indicate to you? I mean, is that retail completely turning away from equities, or do you think that's a near-term aberration only to be plowed back?
No, my sense is that liquid fund, money flowing out from liquid fund is a fairly routine thing. Every quarter liquid funds lose substantial amount of money simply because that is why investors invest their money in them. I don't think it is a reflection of any lack of confidence or anything. If you look at last 5-6 years data, every quarter it happens. It's fairly routine, and that is the purpose of liquid fund. You put your money and you wait for the advance tax, take your money out, pay the taxes, and companies invest in them. It makes sense for them to invest a large amount of money and optimize the return on otherwise idle asset. I don't think there is any. There might be less interest, fewer investors will be excited about equity market, but that doesn't mean that we have seen any deceleration of a meaningful kind. Given by the sheer scale of number of SIPs added, I think this is a deceleration. But I don't think it's quite cyclical in nature. Interest does not sustain at all times at same level, and I don't think that it's an evidence of any permanent strategic decline in mutual funds or equity assets as such.
Dhirendra, just wanted to get in your take as to what the outlook is on these mid-cap flows. You've seen the mid-cap inflow on a month-on-month basis that has risen by nearly 20%. What exactly do you believe investors should look at while approaching some of these mid-cap funds at a time like this?
No, the mid-cap investors, they think that something which has gone down substantially and has not recovered will go up. And what we saw in the last month and a half is that many mid-caps, quality mid-caps, they were coming at a level which was never seen before, because high-quality companies, they have been so pricey of late And that is what the story is. At a certain level, mutual funds are also sold. Investors are vulnerable to buying such stories. They drift from that, and they drift from their simple plan of action, which is put your long-term money in something in a manner which is diversifying and be at it through bad times and good times. People try to time it, people try to optimize it, people try to maximize the return, and the understanding is that if there is any kind of turnaround, mid-caps will make a comeback much sharper. And but I don't know. By that yardstick, I think the small cap fund, which are now far more intensely, far more finely crafted or better classified. I think they should have attracted the money as well.
What exactly, do you think is the outlook in some of the ultra short duration or the low duration fund categories? Because there has been a net outflow over there as well.
Oh, this is a segment of the market, where a substantial amount of, individual investors, well-off investors have invested their money. They have been getting nasty surprise. They are getting nasty surprise for the first time in last 6-7 months. Ever since these 4-5, blow-ups we have witnessed, or the money getting stuck, or the segregated accounts getting triggered. And investors were not, though they are told all the time that mutual funds are subject to market risk, they don't believe it. They think it, it's something which has to be said. It doesn't happen to their money. But what has happened in the last 6-7 months, that is driving greater caution. And what we find is that mutual fund classification has added to the trouble, in the sense that only 2-3 funds which you can make sense of with clarity: the liquid fund, the overnight fund, and maybe the ultra short term bond fund. Beyond all that, it's a very mix of whether it's a duration play, whether it's a credit play. My sense is, and the gilt fund, which is quite understandable, huge return but no investments. So we have 8 to 9 kind of debt fund, which is adding to the confusion, and leaving aside the FMPs, which are also facing some kind of pressure. So investors are naturally exercising caution, moving their money away, and understandably so, rightly so. People should err on the side of caution when investing in fixed income fund, because maximizing return was not the expectation and was not the deal. And if you are faced with a situation that risk becomes real, better to run.
Dhirendra, excluding liquid funds, we have seen some sort of a shift as well among investors towards the less risky debt categories like the corporate bond funds, the banking and PSU debt funds, while the credit risk funds, which are a fairly higher risk category, has seen an outflow to the tune of about 2,000 odd crore rupees. Is this an overall shift that you're observing in sentiment, given the kind of volatility that we're seeing in the equities?
No, it has nothing to do with equity. Fixed income investors are fixed income investors. They came to fixed income funds to optimize the return compared to the fixed deposit or other safe avenues of investing. And mutual funds did present a strong case for themselves in the last 10-12 years. They were able to give superior liquidity. They were able to reduce the risk by and they actually were able to manage the risk, or the risk did not visit them so far. Now in their whatever it be, whether it be their rush to earn that little extra, drifting in a manner, or the cyclicality of the economy, of the economy presenting itself where things are not as rosy as it was expected. So I think this shift, because investors have faced decline in value of such investment which they never experienced before. So the shift out from these funds is quite understandable, and I don't think it will be easy for those investors have learned their lesson the hard way by losing money, and so they will err on the side of caution. Maybe they will get out of mutual funds forever, or they will shift downward and understand fund and get into those categories which are far lower risk.
Okay, Dhirendra, always great to have you on the show and really analyze not just how to read the AMFI data, but what should investors do from here onwards.